Right now, as you're watching this, the stock market is dropping. Maybe your portfolio is already down. Maybe you haven't checked yet, and part of you doesn't want to. Here's the number that should scare you, but not for the reason you think. The S&P 500 is down over 4% just this year. Oil is spiking. Tariffs are at levels nobody has seen since 1935. And every financial headline is screaming the same word: recession. Now here's the part that actually matters. The people who will lose the most money in this downturn are not the people who invested badly. They're the people who react. I'm Felix, and in the next 15 minutes, I'm going to show you exactly what the data says smart investors do when markets fall, and what they never, ever do. By the end of this video, you'll have a clear 3-step plan, not based on panic, based on 100 years of market history. Stay with me, because what I'm about to show you changes everything. Let's start with what's actually going on, because understanding the why is the difference between panic and a plan. In 2025, the Trump administration imposed the largest trade tariffs in nearly a century. The average tax on American imports jumped to 16.8%, the highest since 1935. Think about what that means. Every iPhone, every car part, every piece of clothing coming into the United States got more expensive overnight. Companies started warning their profits would shrink. Investors got nervous. The S&P 500 started falling. Then came the Iran war. Oil prices spiked 66% in a matter of weeks. Gas at the pump jumped 50 cents. Supply chains rattled again. And now, in April 2026, the market is still digesting all of it. Here's the honest picture. The S&P 500 had its worst single day since the COVID crash last year, down nearly 5% in one day. Over $6 trillion in market value disappeared in 48 hours. Those are real numbers. That's real money. But now I want to show you something even more real. Something that changes how you should be looking at this. Every single time the market has dropped like this in the last 100 years, it has recovered. Every single time. Let me give you 3 examples you actually know. March 2020, COVID hits. The market falls 34% in 23 days. That's not a typo. 34%. In 23 days. Economists were saying this could be worse than 2008. Analysts were saying, sell everything. The news was apocalyptic. What happened next? The market doubled. In the following 2 years, the S&P 500 returned over 100%. The people who sold in March 2020 missed one of the greatest recoveries in market history. Let's go back to 2008, the financial crisis. Markets fell 50%. Banks were collapsing. People were losing their homes. It felt like the system itself was breaking. The people who stayed invested, who held their index funds through the worst of it, outperformed the people who sold by 40% over the next 5 years. 40%. Not because they were smarter, not because they had better stock picks, because they did absolutely nothing. One more. 2022. Inflation hit 40-year highs. The Fed raised rates 11 times. The S&P 500 fell nearly 20%. Every finance YouTuber was calling it the beginning of a multi-year bear market. By the end of 2023, the market was up 24%. I'll say it one more time. Every crash, every single one, ended. So why do people still lose money during market downturns? Not because the market doesn't recover. It always recovers. Because of this one mistake, they sell. I know that sounds logical. If I sell now, I stop the bleeding. I'll buy back in when things calm down. Here's the problem with that logic. When you sell, the loss becomes real. It's not a number on a screen anymore. It's permanent. And then you face the second problem, the hardest question in investing. When do I get back in? Think about what that question really means. You have to be right twice. You have to know when to sell, and you have to know when to buy back. Nobody gets that right. Not consistently. Not even the professionals. JP Morgan studied what happens when investors miss the 10 best days in the market over a 20-year period. If you were fully invested from 2003 to 2023, you made 460%. If you missed just the 10 best days, which often happen during crashes and volatile periods, your return dropped to 110%. 10 days out of 7,300. The best days in the market happen right after the worst days. If you sell during the crash, you miss the recovery. It's almost mathematically guaranteed. Now here's where it gets interesting. Because I just told you not to sell. But that doesn't mean you do nothing. There are 3 specific things that the data says you should do right now. And the third one is the one nobody talks about, because it feels completely backwards. Let me walk you through all 3. Step 1. Before you touch anything, you need to understand which money is which. This is the most important thing I will say in this entire video. Pull up your bank account right now. Mentally divide your money into 3 buckets. Bucket 1. Your emergency fund. This is 3 to 6 months of your living expenses. Rent, food, bills, everything. This money has one job: to be there if you lose your income. It does not go in the stock market. It never goes in the stock market. It lives in a high-yield savings account earning 4 to 5% right now. Completely safe, completely liquid. If you don't have this bucket, stop everything and build it first. This is not optional. This is the foundation. Bucket 2. Short-term money. Anything you need in the next 1 to 3 years. A house down payment, a car, a wedding, your kid's school. This money also does not go in stocks. Too much risk for too short a timeline. High-yield savings or short-term bonds. Bucket 3. Long-term money. Everything else. Money you won't need for at least 5 to 10 years. This is the money that stays invested. This is the money that recovers. This is the money that builds wealth. Here's why this matters so much right now. Most people panic during crashes because they haven't separated these buckets. Their emergency fund is in stocks. Their house down payment is in stocks. And when the market drops, they need cash. And the only cash they have is their investment account. So, they sell. At the worst possible time, build your buckets. And the red numbers on your screen become just numbers, not your emergency. Step 2. This is the part that sounds wrong until you do the math. Use the crash. I'm not saying go all in. I'm not saying bet the house. I'm saying if you have long-term money, a crash is not the worst time to invest. It's one of the best. Here's why. This is called dollar cost averaging, and it's one of the most powerful tools a beginner investor has. Here's how it works. Instead of investing $1,000 at one moment in time, you invest $200 a month, every month, same amount. Regardless of whether the market is up or down, when prices are high, your $200 buys fewer shares. When prices are low, like right now, your $200 buys more shares. Over time, you automatically end up with a lower average cost per share than if you'd tried to time it perfectly. Let me make this concrete. Imagine you're investing $200 a month into an S&P 500 index fund. January, the price is high. You buy 4 shares. February, the market drops. Same $200 buys 7 shares. March, it drops a bit more. 8 shares. You've invested $600 and own 19 shares. Someone who invested $600 in January at the high price owns only 12 shares. Same money, different result. Just because you stayed consistent. Now here's the second question everyone asks. What do I actually invest in? For most beginners, the answer is almost embarrassingly simple. An S&P 500 index fund. This is a single investment that holds the 500 largest companies in America. Apple, Microsoft, Amazon, Google, Nvidia. All 500 of them, in one fund. When one company fails, the fund barely moves. When the economy recovers, the fund recovers. Over any 20-year period in market history, the S&P 500 has never, not once, produced a negative total return. Not after the Great Depression. Not after 2008. Not after COVID. You don't need to pick the right stock. You don't need to time the market. You need time, and you need consistency. That's it. Now, before I give you step 3, I want to share something that Warren Buffett said that I think about every time the market drops. The stock market is a device for transferring wealth from the impatient to the patient. Read that again. From the impatient to the patient. Every time someone panics and sells, the money doesn't disappear. It transfers to the person on the other side of the trade, the one who held, the one who kept buying. The crash isn't destroying wealth. It's redistributing it. The question is, which side of that transfer you're on? Step 3. This is the one nobody wants to hear. Turn off the financial news. I mean it. Financial news is not designed to help you make money. It's designed to keep you watching. And the thing that keeps you watching is not information. It's emotion, fear, urgency, panic. Right now, every headline is some version of the same story. Markets in freefall. Recession inevitable. Your portfolio is at risk. Here's what you need to do right now. Do you know what those same channels were saying in March 2020? The exact same things. And the people who listened, who checked their portfolio every hour, were twice as likely to sell than people who checked once a week. That's not a guess. That's a study from Vanguard. The frequency with which you check your investments directly predicts how likely you are to make a panic-driven decision. Here's what smart investors actually do. They set a plan. They automate it. $200 a month, direct debit, index fund. And they look at their portfolio once a month. That's it. One of the best investors of the last 50 years, Peter Lynch, managed the Magellan Fund from 1977 to 1990. His fund returned 29% per year on average. You know what he said about his investors? Half of them lost money because they bought when the market was doing well and sold when it dropped. They had the right investment. They had the wrong behavior. Don't be that person. Let me bring this together. The market is down. That's real. People are scared. That's real. And the worst decisions in investment history were made by smart people who panicked in moments exactly like this one. Here is your 3-step plan. Step 1. Build your buckets. Emergency fund first, 3 to 6 months. High-yield savings account. Short-term money, out of stocks. Long-term money, stays invested. Step 2. Keep investing. $200 a month. Same amount, every month. S&P 500 Index Fund. Don't time the market. Let the math work for you. Step 3. Turn off the news. Check your portfolio once a month. Automate everything you can. Trust the process. The people who built generational wealth through the crashes of 2008, 2020, and every crash before didn't have special information. They didn't predict anything. They just didn't panic. You now know what they knew. You made it to the end. That already puts you ahead of most people. Most people scroll past. Most people say, "I'll figure it out later." Later never comes. You just spent 15 minutes learning what most people spend a lifetime avoiding. That's not nothing. Now there's only one question left. What are you going to do with it? The information is the easy part. It always is. The hard part is the moment 3 weeks from now when the market drops another 2% and your gut says sell. That's the moment. That's where it's won or lost. Come back to this video. Re-watch the part that got you. And if this changed how you think about your money, there's a button below this video. It costs you nothing. It means we can keep making these. See you around. This content is for educational purposes only and does not constitute financial advice. Always do your own research before making investment decisions.